Here is the question that is actually being asked when someone types crypto versus stocks into a search bar. Not which one has better fundamentals, not which one has lower fees, not which one Warren Buffett prefers. The real question is this: which one will take where I am right now and move me somewhere genuinely different? Not slightly better, not marginally ahead, different. The kind of different that changes how you live, where you live, whether you keep working the job you were working, whether your kids start from a different place than you did. That is the question, and the answer is not the one either side of this debate wants to give you, because the honest answer requires you to look at something most financial content refuses to show you: the difference between what the math says is possible and what actually happens to real people in real life when they put real money into either of these markets. Two investors, same $10,000, same year. One goes into the stock market, one goes into crypto. And by the time we work through the numbers honestly, including the parts that are inconvenient, you will understand why this question cannot be answered with a single headline. Meet Claire and Devin. Claire is 31 years old. She works in healthcare administration, earns a decent salary, and has been quietly investing in a low-cost S&P 500 index fund since she was 26. She does not check it constantly. She does not have a trading app on her home screen. She set up automatic contributions, reads about it a few times a year, and goes about her life. She is not trying to get rich in 3 years. She is trying to build something real and durable over decades. Devin is 31 years old. He has been watching the crypto market since 2020, missed the 2021 bull run, and in January 2023 finally committed $10,000 into Bitcoin and XRP. He believes in the technology. He has read about ISO 20022, about Ripple's payment corridors, about Bitcoin's fixed supply and institutional adoption. He is not gambling. He has a genuine thesis, and he checks his portfolio every single day. Both of them are doing something legitimate. Both of them are trying to solve the same problem: not having enough money and wanting more of it before they are too old to enjoy it. The question is what actually happens to them over the next 10 years and what it costs them to get there. Let's start with the baseline that most financial conversations treat as boring, but that is actually the most important number in this comparison. The S&P 500 has delivered an average annual return of approximately 10% per year for nearly a century. That is not a hot streak. That is not one good decade. That is the long-run average across wars, recessions, financial crises, pandemics, and every kind of economic chaos you can imagine. The S&P 500's average annual return stands at 11.5% for the past 40 years as of December 2025, according to Fidelity. That period includes the 2008 financial crisis, the worst recession since the Great Depression, and the average still comes in above 10%. $10,000 invested in the S&P 500 20 years ago in 2005 compounded to approximately $67,000 by 2025. No stock picking, no timing, no stress. Just money placed in a fund tracking 500 of the largest companies in the world and left alone for 2 decades. That's Claire's play. Not exciting, not a story she tells at parties, but $67,000 from $10,000 over 20 years without a single decision after the initial investment is a transformation of financial reality for the average person. Now let's look at Devin. Bitcoin in January 2023 was sitting at approximately $16,500. By the end of 2024, it had crossed $68,000 following the spot Bitcoin ETF approval in January 2024, and by October 2025, it hit its all-time high of $126,000. $100 investment in Bitcoin in 2015, when the price was approximately $300 per coin, is worth approximately $30,000 today. That's a 30,000% return over 10 years. 30,000%. Devin's $10,000, if bought at the January 2023 price and held to the Bitcoin all-time high in October 2025, was worth roughly $76,000 in under 3 years. That's more than Claire's 20-year compounded return captured in less than 36 months. That's the headline. That's the number on the YouTube thumbnail. And it's real. It happened. It's not fabricated. But here's what the thumbnail doesn't show you, and this is the part that separates understanding this market from simply believing in it. That $76,000 figure assumed Devin held from January 2023 all the way to the October 2025 peak without selling. It assumed he sat through Bitcoin crashing from 65,000 back to 26,000 in the first half of 2023. It assumed he held through the 76.9% drawdown that happened in 2022, the year before he even entered the market, which became recent memory for every new investor who watched Bitcoin collapse from 69,000 all the way to 15,000 in just 12 months. It assumed he didn't panic when the FTX collapse wiped out tens of billions in crypto value and sent headlines screaming about the death of the entire industry. Most retail investors did not hold through all of that. The data on this is consistent and brutal. Investors who entered the market in 2021 bought near the top, watched a 70% drawdown, and a significant portion sold before the recovery. The same pattern repeated in 2022, 2023, and 2025. Retail investors, statistically, have a documented habit of buying near euphoric peaks and selling near fear-driven bottoms, not because they're stupid, because they're human. Because watching 40% of your savings disappear in a month is not an abstract experience, it's visceral, and it overrides logic. Bitcoin's standard deviation, its volatility, remains 2 to 4 times that of equities. A 5% Bitcoin allocation carries similar portfolio volatility impact as a 15 to 20% allocation to S&P 500 stocks. That's the lever you're picking up when you enter this market, the same lever that multiplied Devin's $10,000 into $76,000 can multiply a drawdown with equal ferocity. So who actually captured those returns? The people who got rich from crypto are overwhelmingly one of two groups. Group 1, the early adopters, people who bought Bitcoin before 2016 when the thesis was obscure, the asset was genuinely cheap, and the downside was a few $100s of risk capital. Group 2, the conviction holders, people who bought during bear markets, had a genuine thesis they could articulate clearly enough to hold through a 70% loss and stayed in long enough for the thesis to pay out. There are now estimated 241,700 individuals globally with crypto holdings worth $1 million or more. That number grew by 40% in a single year as Bitcoin doubled. There are 36 crypto billionaires. The total crypto market cap reached over $4.3 trillion. These are real numbers, real wealth, people whose lives were genuinely changed by crypto, and the vast majority of them have one thing in common that almost never gets mentioned in the comparison to stocks. They're not people who allocated 5 or 10% of their portfolio to Bitcoin as a diversifier. They're people who believed in it enough to put in meaningful capital at a moment that felt genuinely risky, and who then held through conditions that most people psychologically could not tolerate. 68% of high net worth Americans, people with a net worth of at least $1 million, now own cryptocurrency. 2 out of 3 of those millionaire crypto investors have at least half their portfolio in it. These are not cautious dabblers making a small speculative bet. They are committed to the thesis in a way that the conventional 5% allocation advice completely fails to capture. Now, here's what makes this comparison genuinely complicated, and this is the part where you need to be completely honest with yourself about which category you actually belong to. Claire's stock market strategy works almost automatically because of human psychology, not in spite of it. The S&P 500 does not require you to check your portfolio every day. It does not trigger your loss aversion on a weekly basis. It does not have threads on forums telling you this is the end or this is the beginning of a new era, depending on what the chart did this morning. You set it up, you automate the contributions, and compounding does the work quietly in the background while you focus on your life. The strategy is designed for normal human psychology. Devin's crypto strategy works despite human psychology and requires something closer to iron conviction, a genuine thesis, not just number go up, but a real understanding of why the technology is adoption-worthy and a specific timeline for when and how that adoption is likely to play out. The willingness to sit with a drawdown of 50, 60, 70% and not interpret it as confirmation that you were wrong. The financial cushion outside of your crypto position that allows you to leave the investment alone even when every instinct is screaming at you to cut your losses. The question is not which asset class has better numbers. The question is which version of you actually shows up when this gets hard. Because the math of crypto is more extreme in both directions than any other mainstream asset class in history. Bitcoin's best year produced more than 300% returns. Its worst drawdowns erased more than 80% of its value. The S&P 500's average annual drawdown during bear markets is 20 to 35%. Bitcoin's average bear market drawdown is 60 to 80%. If you cannot hold through that, not intellectually, but in the actual physical moment of watching your savings dissolve, then the theoretical returns of crypto are not your returns. They're the returns of the person who held what you sold. 38% of crypto investors have lost more money than they have made. Almost 1 in 5 investors borrowed money to buy crypto. The average amount invested by retail crypto investors is $7,738, but the median is $500, meaning the distribution of crypto investment is massively skewed. A small number of people invested large amounts at the right time and did extraordinarily well. A much larger number invested small amounts, primarily during bull markets, and experienced losses or marginal gains that did not change their financial trajectory at all. Stocks have their own version of this problem. 512,000 Americans have more than $1 million in their 401k retirement accounts, according to Fidelity's 2025 data. That number sounds impressive until you realize it represents roughly 0.3% of the American workforce. The median 401k balance for Americans approaching retirement is around $87,000. The average hides the concentration. A relatively small number of large accounts pull the mean up dramatically. The stock market has been creating wealth for a century, and the median American retirement account still does not replace income at retirement age. Both of these markets are producing extraordinary outcomes for some people and unremarkable outcomes for most. The question is what actually distinguishes the people who win from the people who just participate. And when you look at that data honestly, the same theme keeps appearing regardless of whether the winner was a crypto holder or a stock market investor. They had conviction that was built on genuine understanding, not performance chasing. They invested capital they could genuinely afford to leave alone while the thesis plays out. They had a specific thesis, not this will go up because it went up before, but a structural reason rooted in technology adoption, institutional mechanics, or economic fundamentals, and they did not panic sell. That is the same profile. It transcends the asset class. So here is the uncomfortable truth that the crypto versus stocks framing almost never allows space for. For someone who genuinely understands the ISO 20022 migration thesis, who can explain why XRP's settlement mechanics matter to correspondent banking, why Hedera's Enterprise Governance Council creates institutional credibility, why Stellar's deployment in real-world payment corridors is adoption evidence, not just marketing. Holding meaningful positions in those assets through a bear market is not a gamble. It is a bet that requires conviction but has structural foundations. For someone who cannot explain those things, who bought based on a YouTube video and a price chart and the feeling that they were going to miss something, that same position is an unmanaged risk exposure dressed up as an investment thesis. The asset class cannot change your life. Your relationship with the asset class is what changes your life. And that relationship is made of 3 things: understanding, conviction, and capital you can genuinely afford to leave alone while the thesis plays out. Claire's $67,000 from $10,000 over 20 years is real and reachable for almost anyone with an income and an automatic investment setup. No expertise required, no tolerance for volatility required, no specific thesis required, just patience and the avoidance of emotional decision-making during downturns. For a large portion of people watching this, that is the most reliable path to a genuinely different financial future. Devin's $76,000 in under 3 years is also real, but it required a bear market entry point, a thesis he understood deeply enough to hold through a 50% drawdown on the way up, and the psychological and financial resilience to still be holding at the peak rather than having already sold to reduce the pain months before the top arrived. Neither path is the one you've been told it is. The stock market is not a guaranteed retirement vehicle. The median retirement account proves that. And crypto is not a casino.
241,000 millionaires and 36 billionaires prove that. Both markets will change the lives of the people who show up to them correctly. Both markets will take money from the people who show up to them incorrectly. The determining variable is not the chart, it is not the cycle, it is not the regulation or the institutional adoption or the central bank policy. The determining variable is whether you understand what you own well enough that the market cannot scare you out of it before the thesis pays out. That's the whole game. In stocks, in crypto, in every asset class that has ever produced generational wealth for ordinary people. The market does not reward participation, it rewards conviction backed by understanding. If that reframe hit differently than what you normally see in the stocks versus crypto debate, hit the like button, not because I'm asking you to, because there are people in your network right now trying to make this decision with half the picture and a YouTube headline, and the like is what gets this content in front of them. Subscribe if you want the version of this conversation that treats you like an adult who can handle real numbers and real psychology, not a sales pitch dressed up as financial education. Now, here's the comment question I actually want answered. Are you a Claire or a Devon, and does your actual behavior with your portfolio match the answer you just gave? Because there are a lot of Devons out there who check their crypto every 4 hours but tell themselves they're long-term holders, and there are Claires who think they're patient but have a stop-loss mentally set at the first correction. Tell me which one you really are. No judgment, just the honest version. And if you know someone sitting on cash right now, frozen between stocks and crypto, paralyzed by the noise, send them this, not to make the decision for them, to make sure they're asking the right question before they move. The right question is never which market. The right question is always which version of you will show up to it.